Good evening, ladies and gentlemen. Today is the 2nd of September and also the weekly expiry. And the idea behind the weekly expiry is generally the market is in a new range. People don't know the boundaries of this range yet, but as soon as the market holds the range for a little bit, everyone tries to build around it. This morning, we were trading with 17,100 straddle pricing in risk of 65 points up and down. The thing is, when market is pricing in low risk, sometimes works out really well to not buy into that and challenge that a little bit, because at the end of the day we almost at one point tripled that range. So it was relatively one of those days where for the longest time people who were short calls did not want to cover calls for trading at discounts at different points into up moves. There was no covering, and at one point the 17,200 really had to get covered. So all said and done, I positioned myself in such a way that initially I had a smaller quantity. As the market started to have certain IV spikes, I sort of increased my position sizing, and I also kept my range super wide so that at a later point, if there is a big move, I can then capitalize on it. So one of two ways it could have worked out: either a big move would come and I'd be able to somewhat capitalize on it, or the big move wouldn't come and I would just close with a reasonable profit target. So all that being said, I closed about 2% in the green, and it was a relatively good day, but the up move could have been frustrating at the point which it was taking place due to the kind of spike in call options. And yeah, one more thing was everyone thought with what happened to USD INR, IT is dead in the water, but just as one starts thinking that, IT makes a new all-time high. I wanted to take a double diagonal trade as well, but now is not the right time to initiate one, and I've covered that in the video as to why it is not the best time. And one more thing that I've covered in this video is how sometimes when we get out of a trade and we do it with the intention of reducing risk, and then we realize that no, had we stayed in the trade, it would have worked out much better. How do we deal with that, and what's the right and wrong way of thinking about that? I've tried to cover that also in this video. Thank you so much for watching. I hope you had a great expiry, and I will catch you tomorrow. Take care. Bye-bye.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. Time is 9:43. My first clip didn't get recorded, so just go over the plan for today. We've opened with a slightly positive bias, Nifty being the strongest relative to all the other indices. Bank Nifty, we opened slightly positive, now kind of trading flat. IT as well opened slightly in the positive, trading flat. Nifty opened slightly positive, still maintaining a little bit of positivity. Reliance very strong right at the open and moved up a good 25 points. And into the open, we saw a good amount of put writing at 17,100 and below. So there's a strong amount of support that is built up. And more or less going by the maximum open interest puts at 77 lakh at 17,000 and call side 81 lakh at 17,200. Very simple range and very evident range. So more or less playing the same range, but this particular criteria, which is that yesterday's closing low, if we start testing that, then I will have to take risk off on the puts and move them down. This particular swing high, if we test there, then we'll have to roll away the calls. Currently, each of my short legs is trading. So one is trading at 8 and the other is trading at 6.6. Either of them starts expanding to about 12, 13, then I will be taking in credit from the other side. And yeah, that's more or less the plan. It's going to be the first expiry that we've ever had without leverage. So will be interesting to see how that pans out. And towards the close, I will consider taking a double diagonal trade. And I will keep you posted on that. So something else to note is the at the money straddle right now is pricing in about 65 points in either direction. Roughly where I've marked out is the range that the at the money straddle is also pricing in, and not giving much space for movement at all. That kind of gives you an understanding that this position is much beyond its pricing and much more risk than what the at the money straddle currently is projecting. And the fact that at the money straddle is trading at such a low price will indicate that even into a down move and up move, these puts and calls will not really gain much, because the anticipation of risk won't go from quite low to very high very quickly. We'll keep you posted. Time is 9:51. basically Reliance keeps its strength, and that's more or less keeping the market quite flat. Something else to go over. I have some positional trades, and these are all covered calls. This Larsen covered call is now at the money. Larsen has just been super duper strong, and 1700 once again a psychological situation. The reason I haven't adjusted any of these covered call positions is because I feel like it's fine. I don't want to take now risk on the downside. I'm a little bit skeptical of just a runaway up move, which goes much higher than this. Like, I'm not expecting another 5% up move on the indices in the next 3 months at least. So that being the case, I don't see any reason why I should manage these calls. My shares have gained equally, so I will let these calls hold, and towards the close of the month I'll see what makes sense to roll over, if at all. Or if these calls go deep in the money, then there won't be much extrinsic value, at which point I will adjust for that. So cover on the Nifty, cover on Reliance, which is almost close to getting at the money once again. HDFC Bank, not really much of a concern. ITC is also quite high up now, and I will enter a covered call position on ITC, probably at about 220. So let's see if I can try and sell this for a good price. Okay, so a little bit of an up move coming from Bank Nifty, making a slight up move, and I'm just taking a look at how open interest has been building throughout the entire day. Basically, the whole market is playing this range at this point, 17,200 max call side OI and 17,000 max put side, roughly equal open interest on either. A lot of straddles at 17,100. Everybody is playing the same range, which is why premiums are so low. People are happily selling this range, and yeah, as of now, the position in a good 8 points of gain. The issue, if we continue to make an up move, now that some time has elapsed, I'll have to adjust this position once it starts reaching about 9-10. I'll have to take additional put side credit, because the credit on my put side is just 3 rupees. So I can't let this expand anything beyond 9 without having additional credit on my put side. But yeah, that's quite a while to go, and that's almost 40% gain that is required from the current market price. We'll keep you posted. As of now, we continue to trade firmly in the green, but a lot of people who are holding, if we make another 20 to 25 point move from here, and people who are sitting on this straddle will start having to cover these calls. So while we might see, so what I'm working with is, and I'll put like 3 points of what I've gained on the line to sort of work with this. What I'm working with is, there might be in case there's a up move beyond 17,150, there might be a temporary short covering of people who are in these calls that pushes us slightly over, but I'm working with this strike holding. Time is 10:47. We'll keep you posted. Okay, so we started showing a little signs of like further heading higher, and into that, what I've done more or less is taken some additional put side credit, because really, if I stay at this strike, there's about 3 points of credit on my put side, and the call was starting to expand as we were heading up to test 17,150. Realistically, 17,150 also very likely expiry spot. I would go with either 17,100 or 17,150, and to just take a little bit put side credit in order to be protected against some kind of a quick up move, I have moved up my puts. So more or less, criteria for adjustment remains the same. If either of them now go to about 11, 12, at that point I will be taking additional credit from the other side and potentially risking off if at any point my strike is about 25 points from what is considered at the money, right? So somewhere around there and there. So, and any point these two are tested, I will just take risk off in that direction. A little bit of an IV spike as well, mildly, but the puts have also gained into the up move, and yeah, that's the plan. The time is 11:06, and we continue to more or less see this range bound structure. Not much unwinding on the 17,100 call, but further addition of 17100 put short. Okay, a little bit of an up move, and into this what I've done is I've moved my puts up further, because as soon as this started expanding beyond about 11-12, there is really no credit left on the 1750 put. So I've now moved my put up to 17100, and together the short side of the position is trading for about 23 to 24, and my hedges are trading for slightly less than 4. So if either of these expands now, if this 17200 call expands till about 1819, I will have no option but to square this off and sell the call, which is 17250. I cannot sit and let this bleed, but more or less I think this move is in line with the anticipation that 15750 was always a potential expiry situation. So I'm not too concerned as long as I'm out of money by at least 25 points. So I'm not concerned until that criteria is broken. And the thing is, there is enough credit available at 17100 put in order to make holding this worth it. Because if there wasn't much credit left at the 17100, then it would not make sense to sit on this call short. But that being said, I've also sort of taken advantage of the fact that we've made this up move, and I've brought in my hedges and increased my sizing by a little bit. So yeah, currently about potentially, I would say 19 points that can be captured on this position. We'll have to wait and see. I might be put in a situation, either of these expands to about 17, 18. I will have to square it off and roll it up. We'll keep you posted. Time is 11:28, and as of now, the 17150 straddle is pricing in slightly over 55 points, so about 57 points in either direction. That would give us either 17200 or 17100. As far as what the rest of the market is doing, it's pretty much in line with that. 17100 put open interest now is maximum open interest, and little bit of unwinding on the 17200 call, but not to a large extent, still firmly above 80 lakh, and yeah, some amount of 17150 put writing as well, but 17200 put still not significant. So this is more or less where we stand, and the idea for changing this also is quite straightforward. So we'll keep you posted. Time is 11:30. Okay, so one question I'm getting in the group, and this was interesting, is how the 17100 call is trading at absolutely no time value. See, that's because most people who are short this call probably have enough and more positions which are in the money. So they have short puts which are either at 17150 or 17200, which is why the demand supply for this is matching in such a way that there is absolutely no time value from this current given level. So that one way of interpreting it is that there shouldn't be too much upside, because there is no extrinsic value being priced in at all, or even if that extrinsic value is being priced in, it's being priced in negative. So definitely the market is of the opinion that no, there will not be too much upside from where we are. That is how I would think to look at it. As of now, we are holding in high levels, and with the way things have been restructured, the new range now becomes 17100 and 17200, with 17150 constantly and steadily building more and more open interest, and then 150 still trading for a good 50 plus, and it sort of gives you the same range. So for now, I'm playing the same range as well, and one of two things can happen. Either we can have a volatile move, in which case most likely we'll get pushed out of either option, because either one heading to about 16, 17, I will have to take risk off on it, and or over a period of time the spread gives up value, in which case I'll be drilling my stop loss further in and trying to capture what I can. More or less where we are. IT, I think ever since the dollar took a beating against the rupee, it's more or less looking like in the short mid-term has made a top previously and will not be making too much of an upset. So that might have completely arrested the momentum that was there in IT. But other sectors are picking up. FMCG is looking strong. Infra is looking good. And yeah, banking as well. It's okay, nothing great, but it's basically all the other sectors that are picking up the index. So that being the case, we'll keep you posted. Time is almost about 12 o'clock, so we're reaching the halfway point. And currently, as of now, the range for today, 17,100, 17,200 looks to be the range. I would think that 17,150 is a high likelihood of expiry or below. I don't see too much upside coming, is what I'm of the view. So we'll keep you posted. We had a mild dip, and after that immediately this dip gets bought. So now this is a very bullish structure, and into that definitely people who have now sold, because most people have sold 17,200 call, will be like, okay, look, it's rejecting, it's not going to take it out. But now with this down move getting completely bought back, and a lot of strength from Reliance keeps heading higher and higher to 2,300. So that could potentially put these calls at some kind of risk. The good thing is that because it's the same understanding of information on both sides, the put has given up some value. Now basically here I will be exiting this at 15. If it goes to 15, I will first exit half my position, move it to 17,250 on the call side, and then I'll exit the other half if it expands to about 16 and a half, 17, and completely just take off the risk on the call side, because now it is becoming too close for comfort. My calls are just 20 points out of the money. The started price remains the same, and obviously the 17,150 call has expanded quite a bit. So it'll be an interesting juncture to see what happens now. There hasn't been much covering through the entire day of the 17,200 call. It's remained quite strong. So that can work in two ways. One, it can mean that the level gets defended, or two, if there is a short covering, can barely get pushed up another 50 points from there. And considering the price of the 17,250 call, it's not like that is particularly safe, but at least my put side credit will be superior to the call side at that point. So it will be an interesting situation. See how it pans out. Okay, done with the first half. We're basically at the halfway point. We're holding at these higher levels, and very quickly the 17,200 invariably is starting to give up value whenever we're making a down move. The thing is, I couldn't have sat on my position. It would have been too much of a headache to deal with. So at about, because I didn't reject in time, at about 15, when the price hit 15, my execution price is 14 or so, I squared off my calls, moved them higher, and I also squared off my puts and rolled them lower because I don't want to deal with a reversal. So I took my 100 point strangle and made it a 200 point strangle. It's because we're heading to the midway point and we've trended up the entire day. Now, if we have an even more continued breakout where the calls are not pricing in that much upside risk to begin with, it will be a headache. If we have a big rejection also, it will be a big headache. So rather than just moving up my calls, I've also moved down my puts, and that effectively gives me a credit of not a lot, about 4 points is the credit that my trade has. 4 points of credit, and for now I'll keep my position this way. Ideally, if there is some kind of an IV spike, then I will try to enter into that IV spike and take more credit, or wait for a time which is closer to 1:30, 2 o'clock to try and take additional credit on this position. We'll keep you posted. Time is 12:42, and yeah, I think so far more or less things are holding as they should. It's just that I would much rather avoid the headache of dealing with short covering much before than after. Okay, so something that I get very often, and I think this ends up working really badly on the mentality of a lot of people. So it's a question like, for example, I risked off on this position at 14 and 7.5, something like that. So let me just see. After that, so I risked off somewhere over here. At this point, I didn't want to deal with it anymore. After that, immediately the call crashed to 8, and at that point the spread was trading for something like 17. I exited at a price of 22, and just like that, bam, it lost 5 points. And a lot of people, when they do that, they feel really bad. Like, they're like, oh, I shouldn't have risked off. I should get my calls, because they'll see, they're like, okay, even though it dipped and then got fully bought back, even then the call is now trading cheaper than the price at which I exited. And this is stupid way of thinking, and if you're ever thinking like that, please get it out of your mind, because when you take risk off, which is essentially to a triangle, you're adding a bull call spread and a bear call spread. You're just spreading, you're saying, okay, whatever I've captured so far is fine, I want to reduce my overall risk reward. Now it's an active step you're taking. Majority of the time when you do that, and especially when you're thinking of doing it, everyone else will also want to be doing it. After you do it, you'll notice that your initial position will make more profit than what your risk off position will. And this will happen, I'd say, frankly, 8 out of 10 times minimum. After you're scared of sitting in a certain position and you take a risk off, and then you say, oh my god, the trade totally went in my favor. Yes, but the one time that it won't have, it'll hurt you. It'll hurt you, and if you don't want to deal with that, it's better to get out early and take risk off early than and wait for a point where you're already bleeding and then you're trying to take risk off. So that's more or less how you have to think of it. Fully accept the fact that after you exit a potentially more profitable position, that position will majority of the times make that profit that you won't be getting, and that is something you have to accept. Also depends on how you want to define your risk reward. Some people say you need to have the conviction. That's fine, you can have the conviction, but if, for example, you are potentially looking at a 2% or a 3% return on expiry day, and you're willing to give up 1.5-2%, then that's very different than, for example, what risk reward I came in with. My idea with the expiry is if I'm able to make 1.5%, that's great. And if I can push out 2% when the situation is deeply in my favor, like for example, what would have been deeply in my favor if he literally, when I was at 100 points triangle, if he literally traded in like a 40-50 point range above and below, that would be in my favor. Right now what's happening is we're only holding at high levels. So I cannot just hope that, okay, we're suddenly going to have a rejection. I can't hope for this. When I exited it, it was about here, right? This candle. I did at potentially what can now be seen as the worst price on the triangle. But I can't hope for this. If I'm sitting there and hoping for this to happen, it's going to really bother me. And that is going to actually throw off my mentality as to what I'm doing right or wrong. Like if I was sitting here hoping that it goes in my favor and then it goes in my favor, I'll have to always look back and say that was the wrong thing to do. So bit of a rant. We are at 1 o'clock. Not much has happened. We once again dipped slightly, got heavily bought back, and we're just holding this very tight range. So we are staying above. We're staying about here, and at different points, I'm just looking at the pricing of the 16200 call. People are not very afraid of it. Like people who have shorted this call are just not very afraid of it. They're not covering it. I think we even went right now. We went all the way till just 8 points away, and at that point also, when we were 8 points away, this call was not trading for more than 14-15. Never spiked beyond that. See, it's in fact having a lower low. It didn't even spike to 15, about 14.5. So that just shows you that people who have written calls there are just not willing to get spooked out, and we've still got half day left to go. So yeah, we'll keep you posted. At this point, like same, that 4 points of credit is what is then, a little bit more than 4 points of credit is what is there in my trade. Paid quite a bit for hedging, hedging costs, so 16,000, 17,000, almost 85,000 just paid for hedging. So that is what hedging costs. But anyway, we'll keep you posted. Time is 1:07, and as of now, I'm happy with where my position is. It has no credit in it, and I want to either. So when do I want to take additional credit? If there's a big move, right? Like if it's a short covering above 17,200, or there's a big down move, and ideally into a up move, I'll not be taking too much credit, but into a down move, I'll try and take more credit. So, and that too when there's probably 1.5 hour, 2 hours left to go for the trading day. Okay, one more thing that I kind of take for granted a lot of the time is that people watching understand my analogy as to why I'm doing certain things. At this point, when I'm risking off on the calls, firstly, why am I also risking off on the puts? That should be fairly evident. It's because the calls are in an IV spike and the puts have given up as much as they can. So in case there's a slight reversal also, the puts will get. That's why it's better to risk off on the puts. Second thing, now if I'm expecting 17,200, I have a pretty high conviction that 17,200 is going to hold, but there might be temporary spikes in it. To be able to sit through it, potentially I can take the 17,150 put credit. Now, why don't I do that? The thing is, right now, the way I see it, the boundaries are 17,100, 17,200, with maximum people sitting at 17,150 straddle. Now, when we are at one edge of the boundary, if I move my put option to what is going to be where all the major straddlers are sitting, a quick move, let's say these guys are able to pull the market down will completely explode the calls and explode the puts, and my calls will not be able to deal with it. So rather than taking on additional risk and taking on additional potential for reward, I would rather take the risk off. That is the analogy. When I'm at this, what I'm considering a boundary, when you're not, I'm not expecting some big up move from here. I'm expecting potentially holding there, maybe spooking out a few of the call sellers and then holding range or coming back. That is why I'm not moving up my puts. And secondly, if you see some of my earlier videos, right? So if you see when we initially started making this series in Jan, I would take very high risk reward trades. Right? I would, by the time it's around 2 o'clock, I would be in like a straddle position, keep a very high risk reward, go inverted. And that was like my steady expiry thing. That was one at a time when IVs were much higher, premiums available were much higher. And secondly, I used to trade with 1/5 the quantity. And interestingly, with trading 1/5 the quantity with such a high risk reward, sometimes returning 10-12% would actually work out in net figures to better profits. But at the same time, with my current sizing, I cannot do that. Mostly because if I'm at the money and there's a big move and I try to exit, I will have to pay huge slippage. There will be a big cost of trying to exit that trade. So that's a cost that I cannot bear. And the cost of doing that itself, I mean, 1 day of terrible slippage on at the money straddle can cost you more than you think. So all that being the case, we're now more or less holding range. And what I'm working with is that we'll probably expire as close to 17,150 as possible. So we might dip low and hit back, or we might hold range and finally dip back. But what I'm working with is 17,150 is probably the most likely spot of expiry. To keep you posted, time is almost 2 o'clock. I don't particularly see any opportunity in taking any credit. If there is some kind of a big move, like we come back to like 17,100, stuff like that, I'll try to move up my put and take a little bit more credit there. I'll also move down my call at that point to 17,200. But until something like that, will not be doing anything. We'll keep you posted. As far as credit is concerned, my put leg has just about 1 rupee 1 paisa, and my call leg has about 75 paisa. So not too much more to gain from here, unless there is an opportunity. Okay, so it's always like Nifty IT that has to play spoil sport. And yeah, so Nifty IT, this consolidated for a while till about 12:30, 1 o'clock, started making an up move and completely rocketing up, and that's pushing the index up quite a bit. But the thing is, if you look at this 17,200 calls trading at 19, with the spot being 13 points in the money, 13 points, 14 points, it's just the market is not having it. Like, this is quite insane. Like, this is, I mean, you'd expect generally around when you're testing, let's say 17, 190, 195, that's when people panic and get out. But they're not panicking, they're not getting out. But there has been some amount of call unwinding and good amount of put writing at 17,200 now, which is reaching about 60 lakhs. So what I've done is into the last 50 minutes, now that it makes sense, I have moved up my puts now because I mean, realistically, it doesn't make sense for me to sit on the 17,100 put anymore. There won't be any credit left, some 50 paisa, with the potential for these calls exploding. So I moved them up. Currently, this is trading both put together at about 6 rupees. If either one of them individually expands to 6 rupees, then I'll be taking corrective action. If not, I'll just let whatever fall off has to happen fall off. And that is more or less the plan. Very, very interesting. Like, into the up move as well, these calls are not really getting covered. There is no panic covering even now, even after it's in the money. So I think for a second, maybe a little bit, but not much more than that. Let's see. Yeah, for a second it exploded from about 16 to 26. But after that, not really buying into the up moves very much. Anyway, now that I've moved my put up, though, first is a reversal risk, and but at the same time, I did it at a point after the breakout was done. So once this up move was done, people who are convinced of this up move started selling heavily the 17,200 put. Once that was done, is when I moved up my put. But there is still obviously a reversal risk. That's why at about 5.5, 6 is where I will get out of it. To keep you posted, we've got about 43 minutes to go for averaging. Currently, in terms of credit, my position has little bit less than 5 points, like 4.7 in credit. Okay, the time is 2:25, and basically eventually the 17,200 call had to get covered to quite an extent. There's a pretty large amount of writing of the 17,200 put,
I'm not writing the 17200 put because I wasn't sitting on the 17200 call, so I'm not at as much threat. I moved my puts up to 17150 at about 3.9, and yeah, that has given up a little bit, and these calls are fine for now. They're not really completely at threat. I wouldn't think so. I think that being the case, though, I still might have to move to the 17200 if these start expanding to about 5.56. So we'll have to wait and watch for that. And as far as yeah, absolutely ending at the day's high. As far as how the day has been, you see, when we opened here 17100, the 17100 straddle was trading at 65. From there, we basically double the risk of what the straddle was pricing is the actual move. So that can be pretty hard to deal with. Okay, I guess it's that point now where I have no option but to move up my puts. I will have to move up my hedges as well. Okay, calls really starting to expand now, and currently, given this position, I will be having to exit if either of them expands to about 12. This is trading at 7 and this at 8.5. What I'll do is I'll be risking off on the call. I'll just square off the 17250 call and move it higher to 17300. Okay, 27 minutes to go for averaging, and more or less I'm doing two things now. I'm running a trailing stop loss on the entire position of 3 points. So anything more, if this short position expands to a net credit of about 14, I will be exiting, and I have exit everything order, which will do about 1/5 the position at a time. I also have an order that will do half the position at a time, but that will lead to big slippage, so I'll not be doing that. And I also have risk off orders in case we start moving in either direction to take risk off in that direction. I think highest probability now would be 17200 to 17250 close, and that's what the data will also tell you, with a high probability of this 17200 straddle going to 0. So more or less the idea is, if there is a reversal, then the fall off on the call side should call side IV should give me a good enough exit on the puts as well. Last 27 minutes, and this is what I mean, like, it all depends on whether or not the market gives you an opportunity to take additional credit, and looks like right now we have that opportunity. Also, one more thing, as the position gets closer and closer to averaging, you'll notice that my size has steadily increased. That's because I'm bringing in my hedge and increasing my position sizing, because there is that much lesser time and headache to deal with. So that's also something to note. Okay, 17 minutes to go. Triangle is now trading in 8. So the point at which I'll be switching out will be if either expands to 7, because beyond that it would be too late. So potentially these calls, once again, a threat. It'll be interesting to see. If it's unlikely that not only have we taken out this and then we take out this, and I'm not seeing as much put writing at 17250. Most of the 17250 puts have been written by people who have calls that went in the money. So more or less that's what the trade works on right now. Right now it makes no sense for me to see what IT is doing, what Reliance is doing, what Bank Nifty will it hold this 36,800 and expect perfectly at 36,800, or will there be further short covering, or will there be a dip? None of that makes any sense to me right now. The only thing that should make sense to me is my position has a credit in the short legs of about 8.5, right? So that's how much I can get, and then you minus this, so roughly you can say a little bit more than 7. If either of these expands to 7, I need to cut it out and then switch my legs, so at least I can capture then an additional 2 or 3, and effectively that position would be a winner, right? And it's basically you're trailing in your exit at that point. So I'll keep you posted. 15 minutes to go for averaging. Will be interesting to see what happens. Okay, so it's about 6:20, and what I'm going to do is let it expand till about 8. That would be a good enough thing. The 17,250 put option is trading at about 18, 19, 20. So that gives you a little bit of an understanding. This put option has to go to 0 for this call option to be worth something. And there's about 10 minutes to go for averaging. And my put side credit, I still have about 1 rupee 50 paisa, not more than that. So overall pretty good, but right now it's all about locking in. I will have to put at least 1 point on the table, because I'm getting 1 point from here. I have to put 1 point on the table here to potentially get 7 points, and that's fine. I guess I'll just stick to that approach. I don't see this. I mean, it will take quite a move. This will have to fall by 10 points instantly for this to jump by about 4 points. So that kind of a drastic sudden move is unlikely, but very much possible, which is why I have to have my hand on the exit button very, very ready to go. Okay, there's 1 minute to go for averaging. In the last few minutes, there is suddenly a spike on the call side. We'll let this expand to about 6.5, at which point I will, it's a little bit of a gamma spike. There's no corresponding spot move. It's just that turn up move and people are very quickly getting out. So you'll have to keep a little bit wider. Currently there's about 6 points here, and yeah, I can let this expand to 6. That's fine. In case it does, averaging will be starting in a couple of seconds, and I think this position should be good to hold unless there is some kind of short covering situation, at which point at about 6 rupees I will be getting out of this call side. I'll keep you posted. Averaging should be starting anytime now, and there we go. Averaging is started. Into averaging we are first few seconds not really making any move, and maybe slightly on the upside. What will be interesting to note is this 17,200 call is going to basically give us whether or not this 17,250 call is a threat. Only if this expands to over 50 will then there be a threat to this call option. So yeah, we'll keep you posted. Averaging is just started, and first few seconds making a slight up move, but because it's happening at averaging, these calls are not exploding as quickly. And if the move doesn't happen and it doesn't actually pull us over 17,250 in the first few minutes, then it's never going to happen. Also, I wanted to take a double diagonal trade, but it will not be happening today. I will not take this trade when we're closing in an all-time high. I'll wait. I'll see tomorrow how the market is positioned, and accordingly I will take that trade. But yeah, calls absolutely melting now because that attempted move didn't come through. Now the only way this position is ever a threat is if either of these expand to 50, which so far doesn't look to be the case, right? And it'll be quite difficult to change the average after the first few minutes and really push it beyond any particular strike. Yeah, I will keep you posted. More or less, I will exit either of these now if they expand to 3. This 3 points here, and that should be potentially the last trade I take. Okay, looks like that's about it. If either expands to 2, I'll be getting out 17,200 and 17,250 holding, and I'll let this position expire completely. I will not be squaring it off because no more MIS, right? So at the end of it, I should be getting about, let's say, 1 rupee 35 pice minus 50 pice, so 85 pice more, and 85 pice more is about 45,000 or so. And yeah, can now take a look at some of my other trades and see if anything needs to be done. Reliance made a big up move today, 2,300. Now, when I sold these calls, you have to keep in mind Reliance was at I think 2,160. So I've got about 140 points profit in my shares, and I have about 1,200 shares of Reliance. And this call is giving me 30,000 loss. So that's fine. I'll keep this as is. At the end of the month, I'll do a rollover because it means overall the trade itself, the position itself is benefited big time. But yeah, now these calls potentially are a threat, and any further up move, I stand to give up some of the gains, which I will see if I have to manage. We are in an extremely bullish mindset, and yeah, since I've already benefited in the bull run with my holdings here, I'll not be making any changes to this. Same with Nifty. Nifty, I'm covering Nifty Bs. I'm not even covering 1/4. So it's fine. It's just single lot. It's in the money now. Let it be in the money. I'll see what to do about it later. Same thing with Larsen. When I sold this call option on Larsen was trading below 1,600. Now it's trading at 1,600, I think. Larsen at 1,700. Sorry, it's been in this steady up move. Okay, it's below, so it's fine. I'm going to leave that as is. HDFC Bank, HDFC are all going to be left alone, and about 1 rupee left to go. Since I'm not actually going to be squaring this off, okay, I'll just go. Okay, so one more thing, people who want these orders, they'll be available in the Telegram group. I think it was an okay day. Definitely the last up move would have caught some people off guard and would have burnt them, would have at least pushed them out of their positions, very likely. And yeah, apart from that, should have been manageable. Okay, that should be about it. There's about 40 paisa in my short position, 45 paisa in my long position, about 30 paisa. So another 15 paisa is what I'll get, and we'll be closing slightly above 8 for the day, and I'll let this expire, and finally we'll have to stop paying Zerodha for the auto square off and whatnot. I wanted to take a double diagonal, but 2 reasons I'm not doing it. One, today India VIX is up. You don't want to do a double diagonal, initiate one when India VIX is up, because ideally you want longer dated options to crash a little bit once. Now, when does that happen? When market understands, okay, this range will hold and all. It will not hold when you're closing at a all-time high. So that's why it's not the best time to do a double diagonal. I'll see tomorrow how things are looking, and accordingly will position myself. So yeah, that's about it. I'll be letting this expire worthless. There's absolutely nothing left. Another 20 paisa or so is what I'll get. And yeah, thank you so much for watching. I hope you had a good expiry, and I will catch you tomorrow. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.